welcome to Leaders of Tomorrow, the only show on Indian television where you, the MSME, get center stage. This is ET Now Special Daily Initiative to give MSMEs and entrepreneurs the opportunity to be front and center on every industry and area that matters to you. Tonight, we're bringing you a master class on different things that MSME entrepreneurs should keep in mind when it comes to approaching a VC, a PE or an angel investor for funding. And joining us tonight to decode just that for you are two investors, two experts. First up, may I introduce Sunil Gupta. He's an angel investor. Also joining us tonight is Srinivas, founder and managing partner at EQ Investment Advisors. Gentlemen, such a pleasure having you here tonight to talk about some of the things that you as seasoned investors like to see, are seeing, and perhaps some of the challenges that you see, some of the issues or concerns that you see, and therefore use this platform to be able to talk to our viewers about how they perhaps should be doing things differently. I want to first and foremost, and as journalists, of course, we love defining things. So let's start with the definition and bucket this in terms of manufacturing companies and services companies. Is there a watertight definition? Should we be looking at that first?
Yeah, so in terms of, let's say, what we're doing right now today, defining services and manufacturing sector, I'll define what services sectors are sectors where you provide services to the secondary businesses like, professional services, IT services, development services, healthcare, education, tourism. These are services which does not produce any goods or products. So these are services industry. And
manufacturing then, is that also?
Typically manufacturing involves using some infrastructure, plant and machinery to produce physical goods which are going into the either OEMs, which is industrial customers, or to the general public. So generally the manufacturing sectors, MSMEs especially, they fall into various categories across sectors like pharma, auto ancillaries, then you have textiles, electronics, all these things.
Okay. My question is also in terms of the advent of technology now. It's changing every industry, and a good example, of course, is what's happening as far as the cab aggregators, the Olas, the Ubers are concerned. When the government was trying to decide what kind of policy framework should apply to this industry, they were flummoxed. They said, is it a tech company that's providing, or is it a transport company? So technology is changing a lot of things. When you as investors are looking at businesses, what role have you seen sort of technology playing when it comes to the classification of businesses?
See, the major factor of when investor looks into those kind of opportunities are whether enterprise is able to scale the business using the technology, because that becomes a big scaling inability. The technology deployment is one factor which can bring a scale to any kind of enterprise, whether it is services or manufacturing.
Fair enough. For the purposes of this masterclass, I thought we could break this up into a couple of different things that you as investors look at. First, let's talk about maybe some of the specific challenges that you gentlemen have seen when it comes to manufacturing and services industries. The top 3 or 4 things that you've seen, as problems or challenges, and then I will come back and say, okay, how do we fix it?
See, in terms of the service industries are categorized largely by you have a team in place, you have some kind of a services to offer, and what kind of a scale and attraction you have in that industry. So I think these are the factors. If you can demonstrate to the investor, then it is good to go. Investors are not looking for huge kind of investment or a big infrastructure setup. It's largely what you're trying to provide services, a key differentiator in the marketplace, and you are able to scale and pursue a kind of attraction in the industry.
On the manufacturing side, actually, the challenges, or I would say the positive aspect first is it's capital intensive. The capex is required for any turning out any goods and goods into the market. So there is since it is asset intensive, the positive aspect is the bank funding would be easier because they can leverage. There is asset coverage, proper asset coverage. But from an equity raising perspective, there are unique challenges for manufacturing. One is the scalability. First thing is the scalability, because the revenue growth completely depends on how much capital you are infusing into the thing. So second thing is the gestation period, as he mentioned. The capex to generate revenue, there is a minimum gestation period required. And Also, getting the optimum capacity utilization also takes 2 to 3 years in manufacturing. Third is most important from an MSME perspective is most of the manufacturing MSMEs operate in B2B business model. Yeah. So, you are dealing with a customer who is well aware of your processes, your costing, your margins. So, you have a limited headroom in terms of your pricing capability. So, these are some of the challenges which need to be addressed properly, articulated properly for an equity investor to be interested in the business model.
Okay, so let me pick up on that. If you're saying that these need to be addressed, you as investors, what sort of solutions would you then provide to some of the things that you just said? So for instance, when it comes to having a product which can prove, you have the proof of concept if you're in the manufacturing space. For an MSME that's looking at the manufacturing industry, doesn't perhaps have the funding, reaches out to someone like you and say, this is the product that I have. Would that be enough? What more would you like to see? And how would you address some of the challenges you've raised?
So, there are various stages once, of a business you should approach an investor. You cannot, for example, at least in manufacturing, you cannot approach an investor at the idea stage or even at the conception stage. So, at various stages, at a majority level of the organization, you should think of investment. For example, I'll give you an example of services industry. Once you have an idea, once you have formed a company and started creating a differentiation of offering your services to the market, it could be B2B, it could be B2C also. So you need to prove that there is enough traction in that particular market space and you are able to scale. So that's where the major criteria of selecting whether you are doing that. Sometimes what happens is people just come with the idea and they say that we want to get funded. That is not the right stage. You need to demonstrate that there is target market for your services, there's a target market ready for accepting you, and then you can create a kind of a scale. That is the time you should have, and you need a funding for going to the particular scale level, so your allocation of activities to grow should be proportional to what kind of investment is required. That sometimes people don't relate together. They look for an investment, but they don't know that I want to allocate so much of money for maybe for sales and marketing, for operations, So they should be very, very clear, and sometimes that is a problem.
Okay.
See, from a manufacturing company perspective, MSMEs especially, if they are at product innovation, product development stage, I think the best resources for them would be the families and their friends, because for an external equity investor to come into the business is a stage where they have at least a proven product, at least couple of customers. So it comes as an early growth stage, is the stage where manufacturing companies can expect to get an external equity investor.
Okay. So both of you gentlemen are raising one very important question in my mind. We started this show by trying to defining services in manufacturing. Yeah. So if we can now define the kinds of investments, because both of you are saying don't necessarily come to investors like yourself if you still are in the idea stage. But for someone then who's looking at going from the idea stage to having at least a proof of concept, there are different kinds of investing. There's bootstrapping, there's VC, there's PE, there's government funding, banks, equity, debt, etc. So can we maybe try and break it up to say at this stage of your life cycle, this is what you should do?
Precisely, the stages are like from idea formation to real setting up your business in terms of growing and expansion, in terms of maturity and maybe market diversification, or it could be like survival also sometimes. So at various stages, for example, the initial stages are largely by the bootstrapping, where friends and family and the angel investor comes into fact. But once you have a growth and you are looking for a scale, that is the time you can approach a VC. And they will also help in terms of expansion, diversification, as well as helping in terms of getting some kind of a mezzanine funding if you're going for an IPO. So at various stages from idea to the IPO, friends and family, angel investors, VC funds get into the picture.
Okay, my question to you is, I just want to add on what Sunil was saying. Is this largely something which is available to services companies? Because for instance, angel funds, would they look favorably at manufacturing companies? Because most of our MSMEs who call us on the Leaders of Tomorrow say that I don't have access to those funds because everyone is chasing after your startups.
See, that is where I think manufacturing has a little bit of a disadvantage, because even at the innovation stage, you are bringing out a physical product which is niche product, So the market has to be established. So your marketing expenses and other things are too high. And the risk profile is little higher because the investment requirement to bring that product into the market is higher compared to in a service industry. So that's the reason why you don't see much, and mostly MSMEs in the idea stage or in the initial stages of the growth until establishment, they are dependent on the families and the friends and close relatives funding. But once they have a product, couple of products and a couple of customers, then that's the stage when they can come to a VC. Again, I said the challenge for them is because the limitation, as I mentioned, the scalability. So they should be able to articulate their business plan very clearly on how they are going to optimize their production facilities in terms of offering a bouquet of products to a large number of customers, including existing customers, increasing the product profile and new customers, and how economically they can expand their manufacturing capacity in a modular way as the business grows. That's a critical thing which is need to be, the entrepreneur should be able to articulate very carefully and very in detail. That's what an investor in the manufacturing sector would like to see, whether how the journey is going to be from micro to small to medium is what contemplated by the promoter.
There's much more that we need to discuss on the other side in terms of some of the things that you would like for our MSME entrepreneurs to keep in mind when they are approaching someone like yourself for investments. Much more of this on the other side. Just stay tuned. Welcome back. You're with us here on The Crux, and tonight we're giving you a masterclass for MSMEs when they're approaching investors for funds. Here's what you should know. So for the purposes then of this masterclass, we've of course spoken about funding. The next thing that we hear very often on Leaders of Tomorrow is talent. As investors who are looking at a company, evaluating a company for investment, how important is it for you to see a well-established CXO level? Is it necessary for small businesses to also have, say a COO and head of HR, etc., if you are to look at it favorably, and also the access to the talent? How much should they have spent on talent? How much good quality talent should have been there on the books, considering that these are still small businesses?
See, these are different for different, as I'll talk about the services company. Initially, when they are in the early stage, when we call seed funding stage, what matters is the team, the founder's capability and the competence and their domain knowledge. Or because there is no precedence in terms of what they are offering. If they are an innovative company, they don't have a kind of historical background in terms of proving that this has worked somewhere else. They are trying to bring something new. So what matters to the investor is largely the team and the competency of that particular team, founding team. It could be the founder, or it could be the initial employees of the venture also. So that is most important in terms of the early stage company. Yes, going forward, I don't recommend, in fact, we don't look forward in terms of companies to start with a big structure that, they have different departments, and the entrepreneur need to do everything on their own from every department, every aspect he has to handle. But as and when you grow, obviously when you scale, but that is at a later period, you need to demonstrate that yes, you can scale, and you're going to put a team in place with the right kind of skills and competence.
Sure.
I think in manufacturing also what Sunil said holds the same thing. Only quite often what we encounter is the promoter's unwillingness to bring in the CXO level candidate because of the cost. Because in manufacturing you are dealing with the very wafer thin margins. So the cash flow and other things, limited cash flow availability, that's a valid reason. But as the business grows up, scales up, I think it is very much required that they should bring in the professional management. But till that time, yes, as an investor, I depend on the entrepreneur's capabilities and his domain knowledge. Sure. And his ability to scale up the business.
You raised an important point, and I just want to go back to that. A lot of businesses which are MSMEs are, of course, family owned and managed. Would you look more favorably as an investor at a company which is also perhaps has external professionals they've brought in? Or would you say it doesn't make a difference as long as the team is able to prove its capability, whether it's family owned and managed or it's family owned but professionally managed?
No, in fact, what matters initially is obviously our promoters are there, so they have built the business. So they should be transparent enough, they should have a governance and a framework in place in terms of policy. They're not taking kind of ad hoc decisions, and they're very transparent and open to ideas. I think that is most important. So once they demonstrate that, investor has the confidence in, but they should be also open enough that going forward, as they scale, they need to bring professional inputs, professional management. So they should come with an open mind rather than, keeping a closed door approach.
I think that the professionalism is required, it's desirable. As you said, if the family business already have some professional management, good, but it's not mandatory. What is mandatory is their willingness to bring in the professional management as and when the business grows, as and when it becomes difficult for the entrepreneur himself managing the entire shows.
Okay, so I want to ask both of you then your advice for entrepreneurs who are based in tier 3, tier 4, tier 2 even, who say that we don't have access to this talent. Then what would you advise them about how they perhaps are able to get the kind of talent that their business needs?
See, from a talent's perspective, obviously when you are setting up an industry in a tier 2 or tier 3 cities, which are very different for manufacturing and services. So I'll give an example of services industry. What you need is also the ability of people to deliver those specific services to a client. So sometimes these are not available, so you need to in-house train those people. Some of these are very, very specific. The other thing is that in terms of attracting a talent is a challenge from, let's say, if you want to attract talent at a higher levels, from bigger cities to the tier 2, tier 3 cities is always a challenge. But then once you show a kind of a growth plan or a growth aspect to that particular candidate, participating his wholly into the ecosystem of stakeholding or maybe ESOPs or some amount of integration of his capability into the organization growth, I think that will attract a lot of talent. And that is happening. The people are, in fact, the people who migrated from the rural areas to the cities, they are now coming back to some of these things because they see a growth there.
Correct.
All right, a couple of questions as we're winding down. First is, we were talking about the manufacturing space earlier and about how you have to have the proof of concept if you're approaching investors like yourself.
Correct.
That said, we get asked very often on the Leaders of Tomorrow, what value investors like yourself place on the core idea itself? If there's a fantastic idea, but they don't have the funds to scale, would you still look favorably at something like that?
See, what we definitely look for, and we get these kind of opportunities where the entrepreneur has a very vague idea of a product, very vague idea about that. But then, as an investor community, as an angel investors or a VCs, we come with a huge amount of experience in terms of building the whole companies, and we definitely look for opportunity where we can complement, and we can help that entrepreneur. We feel that, yes, he has a right idea, and with our help, because we are more of a strategic investor, then we bring not only the finance, but also the aspect of connecting that person in terms of product positioning, product market fit, product development, opening the doors to the customer, and we can help that entrepreneur to grow at a larger scale with our involvement compared to his own efforts.
Okay, so you're saying the idea, of course, does matter, and you do.
Yes,
and you do.
Absolutely, we do value that idea. Only thing is, what we expect is our participation. He should be open to our participation. Because we do, as he said, we do come with a lot of experience, having seen many of these investments. So quite often we would like to add value in terms of refining that idea, making it a commercially viable product, because some of the ideas may be not commercially viable. So that's the input what we try to bring into the table, which should be acceptable by the promoter.
If you could, through this show, talk to our MSMEs who are looking for investment about how to make a successful pitch. What is the role that a successful pitch is perhaps making? What are some of the common mistakes you see when companies are pitching to you for investments? And therefore, talk to our viewers about how to perhaps avoid those common pitfalls?
On the manufacturing side, yes, what we see quite often, the foxpaws, what you are mentioning, the business plans when we get, we see a lot of overestimation, optimistic projections and underestimation of costs, because in manufacturing it's all about the costs and margin improvement. So the entrepreneur should be able to clearly articulate how the cost efficiencies will be brought in and how the margin improvement can happen. So that's one of the things which need to be a part of the pitch. Second is, as an equity investor, we have a definitive time frame within which we need to exit. The manufacturing is a journey, an infinite journey, I would say. So he should be able to clearly keep in mind where the next level of growth is happening and slot them and show clearly where the exit options are available for the equity investor who is coming into the manufacturing.
See, he also adding to what Srini said, that you need to be very, very comprehensive when you're trying to present your pitch to the investor. You need not, do an information overload or make huge jargons and create a big kind of a financial projections without any kind of a backing of that particular thing. So you need to very clearly define what exactly is a problem you're trying to resolve, what is the market opportunity for that, what is the investment required, and what is the team competency and capability to deliver that result. And obviously the exit, what investor looks forward.
All right then, gentlemen, it's been very exciting to be able to break down some of the things that you as investors see being repeated commonly as mistakes, and therefore advising our MSMEs and viewers about what perhaps they should keep in mind if they're approaching someone for investments. Thank you both very much for being here.
Thank you. Thank you for having us.
That wraps up this episode. If you have any specific questions about how you too can perhaps approach an investor for funds, here's how you can reach us. Leave your comments for us at leadersoftomorrowtimesgroup.com. On social media, tweet at me at Sunanda_J or LOT_ET now. You can also leave your comments for us on our Facebook page, Leaders of Tomorrow on ET Now. Thanks very much for watching. As always, it's been a pleasure bringing you this special episode.